debt is a word that often carries a negative feeling. It's associated with financial strain, stress, and even shame. However, not all debt is created equal. There are different types of debt that can be good or bad for your financial health. In this video, we will explore the meaning of debt and look at some common examples to help you understand how it can impact your life and finances. So, what is debt? At its core, debt refers to an amount of money borrowed by one party from another. A debtor, known as the borrower, has an obligation to repay this amount plus any interest or fees agreed upon when they entered into the loan agreement with their creditor, known as the lender. This repayment process typically occurs over a set period of time through regular installments. While it might seem counterintuitive at first glance, some types of debt can actually benefit your financial situation in the long run. To differentiate between these positive and negative forms of borrowing, let's look at some examples of good and bad debts. Good debts are those that have the potential to improve your overall financial situation in the future by either increasing your net worth or providing benefits such as better job prospects or higher income earning potential. Here are a few examples. Mortgages. When you take out a mortgage to buy a home, you're investing in an asset that generally increases in value over time. As long as you make timely payments on your mortgage and maintain the property well, home ownership can lead to wealth building through increased equity. Student loans. Investing in education is one of the best ways to increase your earning potential over time. Although taking on student loans may seem daunting, it's important to remember that higher education can lead to better job opportunities and higher salaries. Business loans. If you have a solid business plan and are confident in its success, taking out a loan to start or expand your business can lead to increased profits down the line. Low-interest personal loans. These loans can be used for various purposes, such as consolidating high-interest credit debts, a car which you might need to get to work, or making home improvements that add value to your property. These are the loans you would most likely get from your credit union or your bank. Bad debt refers to borrowing money for short-term gain rather than long-term needs or investments. Essentially, this is credit, which uses borrowed funds for consumption rather than growth purposes. It is important to note that the use of the word bad is not to imply anything other than the fact these types of debt could worsen someone's financial situation, especially if they are not well managed. Credit cards. Credit card debt is one of the most common forms of debt, and we only categorize this as bad due to its typically high interest rates and how easy it is to accumulate a high balance in a short space of time. When you carry a balance on your credit cards, interest charges pile up quickly, making it difficult to pay off the principal amount owed. Additionally, many people fall into the trap of only paying the minimum monthly payment, which prolongs their repayment period and increases their overall interest cost. If a credit card is used properly, for example, a one-off purchase is made and then repaid the next month, it is far less likely to do financial harm as long as it is affordable. To avoid credit card debt, pay off your balance in full each month. If you cannot pay in full, at least make more than the minimum payment. Keep track of your spending to ensure you don't overspend. If your credit card comes with a mobile app, you can use this to regularly check your balances and spending. Consider using a debit card or cash for purchases instead. Payday loans. These are short-term loans designed for individuals who need quick cash before their next wage is paid. These loans often come with high interest rates, sometimes exceeding 900% APR, and fees that can trap borrowers in a cycle of debt. To avoid payday loans, build an emergency fund for unexpected expenses. Seek alternative sources of funds, such as friends or family members if possible. Explore lower-cost borrowing options like personal loans from banks or credit unions. Now, let's look at some examples of harmful debt. This is the ugly. Home credit, or doorstep loans, is where you borrow money and the lender visits your home to collect the repayments. The loans are usually for smaller amounts and you will be charged a high rate of interest for borrowing in this way, sometimes as much as 300% APR. Usually there is a relationship built up over time with the person who visits your home. This makes it much easier for the lender to convince you to borrow again. Loan sharks. Loan sharks may start out appearing friendly, and if you keep up your repayments, they might stay that way. But the reality is, even if you do, any money you borrow will come at a high price. There are many risks attached to borrowing from a loan shark. For example, you pay far more in interest than you would through any legal borrowing. You might be harassed or threatened if you get behind with your repayments. You might be pressured into borrowing more money to repay one loan with another and end up in a spiral of debt that you can never repay. Loan sharks are illegal lenders, and you should report them if you come across them. Remember, debt is not always a bad thing. If used responsibly, it can help you reach your goals faster than saving alone. With the right knowledge, you can use debt as a tool for reaching your financial goals. With the right understanding of the different types of debt, you can use it as a tool to your advantage. You can also avoid harmful debt. We hope you found this video useful. You can visit our website or YouTube channel for more information about debt and how to manage it.